Hello everyone. I am Mallikarjun from Adarsha Shikshana Samiti's College of Commerce, Shri Devraj Manohar Chand Bagmar Memorial PG Course in Commerce Mcom Gadag-Betageri. Now we are conducting digital seminar on the subject of accounting for specialized institution under the guidance of Professor Salma Belgum, and our team members are Aman Sab K, Malika, Mallikarjun K and Manjunath D. In this subject, I will explain the classification of assets. Before explaining the classification of assets, we want to know the what you mean by assets. Assets means valuable resources owned or controlled by an individuals, organizations, and businesses is called as assets. Classification of assets on the basis of liquidity or time to convert into a cash. In this basis of liquidity, there are two types. First one, current assets and non-current assets. In the current assets, these are assets that are expected to be converted into a cash or consumed within 1 year or within the company normal operating cycle is called as a current assets. Current assets means these are assets converted into a cash within 1 year or short term is called as a current assets. For example, cash and cash equivalents, accounts receivables, inventories, prepaid expenses, and short term investment is called as a current assets. And second type is non-current assets, also known as the long-term assets. These are assets that are expected to provide a value for more than 1 year. They are not intended to sold or converted into a cash within a short term. For example, property, plant and equipment, intangible assets, long-term investments, and deferred tax assets is called as a non-current assets. Non-current assets, in simply said, non-current assets means these are assets not converted into a cash within a short term. It's take a more long term for converting a cash is called as a non-current assets. And then moving to the next, classify the assets on the basis of physical existence. In the physical existence, there are two types. First one, tangible assets and intangible assets. Tangible assets, these assets have a physical form and can be touched or seen, is called as a tangible assets. For example, land, building, machinery, equipment, vehicle, furniture. These are the example for tangible assets. Tangible assets means it is a touchable or visual for a normal eyes is called as a tangible assets. Also, land, building, machinery. These are also touched or seen or vision for a normal eyes. And move to the intangible assets. Intangible assets means these assets do not have a physical presence but still provide a long term value. They are often linked to intellectual property or rights. For example, goodwill, patent, trademarks, copyrights, software, franchise agreements. These are the example for intangible assets. Intangible assets means these assets are do not have a physical presence and do not have a touched or do not have a visual for normalize is called as a intangible assets. Classify the assets on the basis of usage in a business operations. In this basis, there are two types. First one, operating assets, and second one, non-operating assets. Operating assets, these are assets that are directly involved in the core business operations activities is called as the operating assets. Or operating assets, which assets are directly involved in the business activities or business operations, these called as the operating assets. For example, inventory, equipment, account receivables. These are assets directly involved in the business activities operations, that is the operating assets. And second one, non-operating assets, these are assets not directly involved in the main business activities or main business operations but might still hold value. These called as a non-operating assets. For example, marketable securities, real estate properties not used for operations. Marketable securities and real estate properties not used for operations. These are not directly involved in the main business activities. Still hold is called as a non-operating assets. And fourth one, classify the assets on the basis of ownership rights. In this basis, also two types. First one, owned assets, and second one, leased assets. Owned assets means these assets are fully owned by the business or individuals or organizations. There is no label associated with them other than depreciation is called as a owned assets. For example, owned land, owned machinery. Owned land and owned machinery is a own. It is ours. There is no label on it. And second one, leased assets. Leased assets means these are assets that are business rents for or lease rather than owns. For examples, leased equipments, leasehold improvements. Leased equipments is a take as a rent from others for a business activities is called as a leased assets, because this is not our own assets. This is a leased assets. This is taking as a rent from others is called as a leased assets. And last one, classification of assets on the basis of financial reporting standards. In this basis there are two types. First one, financial assets and non-financial assets. Financial assets means these assets include cash, equity securities, and financial instruments like bonds or loans is called as a financial assets. For examples, stocks, bonds, bank deposits, receivables is called as a financial assets, because it is related to the cash or related to the financial instruments. And second one is non-financial assets. Non-financial assets means these do not involve financial instruments but are a physical form and might be a intangible resources is called as a non-financial assets. For example, property, plant and equipments, inventory, goodwill. Property, plant and equipments is a physical form, but it is not related to the cash or financial instruments. It is the assets. It is not related to the finance. So it is the non-financial assets. Thank you. And over to the Aman Sab.
Hello everyone, I am Ansab. I am explaining the provisioning requirement for preparation of financial accounting. These are bad debts provision, depreciation provision, provision for taxation, provision for warranty and guarantee, provision for pension and employee benefits, provision for restructuring, provision for contingency liability, provision for inventory obsolescence. First one, bad debts provision. Bad debts provisions is also called as doubtful debts. The purpose of accounting receivables that are accepted to be uncollectible. It requires the estimate portions receivable that not to be paid and create the provision for bad debts using the preparation of based on past experience and aligning the receivable. Second one, depreciation provision. The purpose to allocate the cost, tangible fixed assets over the useful lives. It requires the calculate the depreciation assets using the appropriation method. Example, straight line reducing balance and providing the match the usages and aligning the assets. Third one, provision for taxation. The purpose of accounting for income tax liability that have the accrued but not to be paid in future period. It requires the estimated liability for the considering the tax rates and accounting for any tax credits and adjustments and make the provision. Fourth one, provision for warranty and guarantee. The purpose of accounting to accepted cost related to the warranty claims and product guarantee. It requires the estimated future cost based on historical data and claims to provide for future expenses. Fifth one, provision for pension and employee benefits. The purpose to cover the future pensions and other post-employee benefits. It requires the depending on accounting framework, example, international financial reporting standards and generally accepted accounting principles. Provisions must be made for obligations such as pension liabilities and other long-term employee benefits. Sixth one, provision for restructuring. The purpose to cover the cost-related plan restructuring activities, example, layoff, facility closure. It requires the provisions are only made when a restructuring plan is detailed and there is a commitment to carry it out. Seventh one, provision for contingency liability. The purpose of recognizing the potential liability that may be arises of uncertainty event. Example, pending the lawsuits and legal disputes. It requires the estimate the likelihood amount of contingency liability and create the provisions if probability of outflow of resources and probable measurable. Eighth one, provision for inventory obsolescence. The purpose of accounting inventory that may become obsolete or unsellable. It requires the estimate obsolescence of inventory and create the provision to reduce the inventory value as a net receivable. Ninth one, provision for environmental liability. Purpose, the accounting liability related to the environmental cleans recognition of future. It requires the when applicables estimate the cost of environmental redemptions. It provides the provision for environmental liabilities. Tenth one, provision for impairment. The purpose of adjusted carrying value of assets when it is deemed impaired. Example, that assets carrying amount exceed its recoverable amount. It requires the review of carrying value and non-current assets and create the provision for impairment where is necessary. 11th one, provision for legal and settlement cost. The purpose of cover the accepted costs for ongoing and potential legal disputes or settlements. It requires the for provide the anticipated cost of their probable outflow of resources and amount can be reasonable estimated. 12th one, provision for foreign exchange losses. The purpose of accounting potential foreign exchange losses from fluctuating the currency values is
Hello everyone, I am Manjuna. I explain step for recognizing provisions. Step 1. Identify the need for provision. Based on the business operations, estimate the future obligations that should be provided for. Step 2. Calculate the amount. Use reasonable assumptions, historical data, or actuarial assessments to calculate the amount of provision. Step 3. Adjust financial statements. The provision is recorded as an expense in the income statement and has a liability on the balance sheet. Step 4. Review and update provisions. Regularly reassess the provision made and adjust for any changes in circumstances or estimates.
Thank you. Do like, share, and subscribe.